Hello. A very good morning to all present here today. My name is Sudarshan, and I will be taking you through today's webinar, where we review the monthly market. So this will be our agenda for the day. We will first begin with a quick look at the G20 summit that recently concluded in Hamburg and their views on the global economy, the Indian economy, and based on all of these, we will look at how these affect your finances and an investment strategy. Let's start off with the G20 summit in Hamburg. The statement released by the G20 was that the global economic recovery is progressing and gaining momentum. Investment has picked up, and trade and manufacturing are showing signs of recovery. However, the pace of this growth is still weaker than desirable, and downside risks remain. We will look a bit more in depth at these in this statement in the coming slides. Among the highlights of the G20 summit was that the leaders were committed to reduce competitive devaluating of their currency. Economies would typically devalue their currency so that they have economic and export competitiveness. There was also a focus on sustainable debt to GDP ratio and a focus on fair trade, taxes, and agreements. To look a bit more in depth at these statements, we will begin with an examination of the European Union's economy, where the G20 summit was recently held. The inflation in the European Union is about 1.3%, and in United Kingdom, which recently initiated proceedings to exit the European Union, the inflation was at 2.9%. The unemployment rate in the EU for the month of May of 7.8%, which is still a comfortable low from where it was about a decade ago. The same can be seen about the United Kingdom. Now, the European Central Bank would love to have the inflation of the EU at about 2%. The 1.3% is less than the 2, but it's still a positive indicator for the European Central Bank. These have suggested that the European Central Bank will exit buying of bonds by the beginning of next year. And with the tapering of bond purchase, what we can expect is an ease in the a reduction in the quantitative easing for the expansion of the economy. Now, examining the sentence made by the G20 with regards to growth not being as fast as expected or being weaker than desirable. If you look at the EU's and the British GDP expansion in the first quarter, it was only about 0.5% and 0.6%. But if you look at the PMI, an indicator of the performance of the economy, the manufacturing PMI hit a high of 57.4. And overall composite PMI is 56.3. A reading of over 50 indicates that there is growth happening. An indication of 57.4, 56.3 suggests a very rapid growth. And this once again conforms with what was declared by the G20, that the trade and manufacturing are showing signs of recovery, but still, the GDP number suggests that there are still a lot of growth that can be expected. Looking at Japan, the unemployment rate in Japan is about 3.1%, and inflation is at 0.4%. The wage growth at 0.7%. And like the European Union, the GDP growth for Japan in the first quarter was at 0.5%. This by no means is a strong suggestion of growth, but it is growth nonetheless. And Japan is an export-driven economy, and most of it and most of the exports are in the form of manufactured goods. And when manufacturing shows an expansion of 52.4, it suggests that the economy is still on the way to growth. However, growth still needs to be much stronger than this. Among the statements that the G20 had made, it suggested there will be a focus on sustainable debt to GDP ratio. Now, Japan's debt to GDP ratio as of December 2016 was about 250%, which means that the amount that Japan owes is almost 2.5 times the size of its GDP. However, Japan still continues to be one of the most preferred destinations for investment. Japan is considered an alternative to the United States as a safe haven investment. The Bank of Japan is set to raise its economic forecast for the coming quarters. However, it has lowered its expectation of the inflation in the coming quarters. The Bank of Japan, just like the European Central Bank, would like to have an inflation up at about 2%. Now, core inflation of 0.4% may not be much, but this should be considered with the fact that Japan has had chronic deflation since the 1990s. In which case, 5 consecutive months of positive inflation is a short positive sign that there are better economic times to come. When we look at the economy of the United States, the unemployment rate in the United States was 4.4%, a low that wasn't last seen since before the Great Recession. Jobs added in the month of June were about 220,000, and wage has grown at 2.95%. Now, although jobs have been added at such a rapid rate, wage growth is yet to catch up. And because wage growth is still yet to catch up, inflation will take a bit more of time to reach where the Federal Reserve would like it to have. And it's because of this that Ms. Janet Yellen, the chair of the Federal Reserve, recently testified in front of the House of Financial Services that there will be slower than expected rate hikes going ahead. Now, when we look at some of the economic indicators, such as the manufacturing PMI, the services PMI, and composite PMI, all of them have grown at a much faster rate than they did in the month of May. Now, the USA also has a very high debt to GDP ratio. The debt to GDP ratio of the United States as of March 2017 was about 104%, which means that roughly the United States owes as much as the size of its GDP. There have been a lot of problems with regards to, there have been a lot of calls as to whether the sustainability of the US economy's growth will be able to pay off the debt. About a few years ago, there were also calls for raising the fiscal limit by the United States in order to avoid such an unsustainable growth in the debt to GDP ratio. Now, in the first quarter of 2017, the US economy had grown about 2.1%. A 2.1% it's a much better GDP growth since the Great Recession, historically speaking. And this comes at an interest rate of about 1.25%. Now, although wage growth has not been as strong, there have been few positive indicators for the US Federal Reserve to raise interest rates. Although they will be slower than expected. In the last month, in mid-June, the US Federal Reserve had raised short-term interest rates at 0.25%, which means that the US Federal Reserve is still looking to ease the amount of free credit available, but it will do so in a measured way. Next, we look at the world's second largest economy and one of the most prosperous emerging economies in the world, specifically Asia Pacific and China. Now, the composite PMI of China is 51.1. This suggests an expansion, more of a moderate expansion really. But if you look at the manufacturing PMI in China, in the month of May, reading the manufacturing PMI reading for China was 49.6. This suggests that the manufacturing activity actually declined in the month of May. But the June reading suggests 50.4, meaning there was a marginal expansion in the manufacturing activity. Now, as you may know, China is the factory of the world. And when a PMI of close to 50 is what China is experiencing in manufacturing sector, it suggests that the all is not really well with the Chinese manufacturing system. Now, the Asian economies, that is the Southeast Asian economies, are largely dependent on China. Now, if you look at the month of May, the manufacturing PMI for China was 49.6. Now, this will have a spillover effect on the Asian economies, which is why we can see that the manufacturing PMI for the Asian economies for the month of June was 50.0, suggesting that there was no expansion, but there was no contraction either. The first quarter GDP growth of China was at 6.9%. This was primarily because of a very high property boom that is fueled by government's infrastructure spending, which in turn boosted industrial output. But China is going the same path as Japan did in the 1990s. The debt to GDP ratio of China as of March 2017 is 327%. And about 6 months ago, this was about 250%, which suggests that the most of the Chinese growth is currently fueled by debt. And this in turn was one of the biggest concerns in the G20 summit. The focus once again in the G20 summit was to bring debt to GDP ratios to sustainable levels. Now, with 327%, the world's second largest economy owes about 3/4 times the size of its economy in the form of debt. The People's Bank of China had pumped in about 40 billion into the financial system through reverse repos. Now, when the Federal Reserve did raise the interest rates, the short-term interest rates that is, the Bank of China was also tempted to protect its own currencies, the currency outflows. So although there was a call to raise interest rates the last month, the People's Bank of China did not do so. Instead, they too raised the short-term interest rates, thereby arresting the outflow of capital. Looking at some of the commodities, looking at the Latin American economies, Brazil, which is the largest economy of the region, expanded by 1% in the GDP last year, in the first quarter of this year. Now, why this is important is because Brazil had experienced a chronic recession for almost two and a half years, and an expansion of 1% in the first quarter suggests that well, the worst is over for Brazil, but the best is yet to come. However, Brazil is not entirely out of the ruts as well. The composite PMI Brazil and services of Brazil are still in the red. The PMI activity for Brazil in June for services was at 47.4, which means it has declined faster than it did in the month of May. However, manufacturing is still expanding, although at a much more slower rate. Now, Mexico is the biggest exporter to the United States from this region. And Mexico is also, similar to China, a manufacturing dependent economy. Now, despite the protectionism in the United States, the Mexican's manufacturing PMI has expanded to 52.3. And Mexico, which was expected to have a hard landing, just like China, expanded at 2.7% in the first quarter. All of these suggest that there are green shoots in the economy, but there is still a lot more that can be expected. Looking at the commodities, much closer home in the Middle East, the OPEC had decided to to extend its production cut for another 9 months in the mid of May. However, this was deemed insufficient, which is why, as you can see to your graph in the left, prices of oil has declined from highs of the $51 to close to about $42 over the month of May and June. There was a brief rise in the in the oil prices, but however, reports of the US oil inventories and the persistently low demand from China and continued high production output, all of these have brought down the prices again. Supply continues to exceed demand, in which case oil prices might actually decline in the coming weeks. Gold is the second most imported commodity in India, and gold prices rallied through most of May and reached a peak of about $1,287 in the beginning of June. Now, the economic indicators for the month of June suggested that the United States was expanding at a reasonably good rate. Additionally, with the Federal Reserve raising the short-term interest rates, dollar had gained a lot more in the month of June. Now, dollar and gold have an relationship. With the Federal Reserve's move, the dollar gained and gold had declined, and it had declined through most of June. Now, in the last meeting with the Federal Reserve, when, as we had discussed under the United States section, the Federal Reserve might raise interest rates at much slower rate. This suggests that all is not particularly well with the US economy. So the dollar gained, the dollar lost and the gold gained. Looking at all of this, we come to India. Post the demonetization, there was a brief lull in the services sector. For the first time in almost 5 years, the services sector had shown a decline in the first quarter. However, the Indian economy was able to shrug it off, and both manufacturing and services economies were able to pick up. The overall composite economy for the month of June was at 52.7. Now, the RBI has been there have been many calls by the RBI to lower the interest rates in the past in the year to date. In February, the RBI had changed its stance from accommodative to neutral. At that particular time, inflation was high, and RBI was concerned about the inflationary pressures caused globally. Now, the RBI would like to keep the inflation rate to be between 2% to 6%. In the month of June, the consumer price index based inflation suggested a reading of 1.54%. But the wholesale price index was a surprising 0.9%. The primary reason for this has been attributed to lower food costs. And the lower food cost is probably because of the excess of 4% surplus in monsoon in the month of June. Another bigger economic event that occurred in India was the rollout of the GST. The GST is the biggest tax reform since the independence of India. This unites India as a whole in terms of a tax structure. Now, with the rollout of GST, some prices have gone up and other prices have gone down. Essential food prices have been reduced, and prices of certain services like financial services or restaurants, shopping have increased. In the G20 summit, India was lauded for being encouraging of supporting growth. The efforts taken by the government to boost startup funding was recognized, and the government's push to attract more investment in the form of Make in India was also recognized. However, most structural reforms are required for the growth of India to reach what they were in the early 2000s. Towards this, the government of India has initiated labor reforms in the form of a guaranteed minimum pay. However, the rollout of this particular scheme will take a bit of time. Now, we will now look at how all of these will affect you. First, uh, because of the crisis in the Middle East, the excess oil surplus, and the low demand, fuel prices will go down, meaning prices of petrol and diesel are likely to be revised downwards. When the Federal Reserve had made comments about how it will be slowing uh, the raising of the interest rates in the coming quarters, the dollar had weakened against basket of currencies, which includes the rupee. Now, with the strengthening of the rupee, importing of goods in China will become much more. Importing of goods into India will become much more cheaper. So, imported goods will actually become much more affordable than what they were. The same statement also suggested that the value of dollar will weaken and gold will increase. Consequently, the prices of gold jewelry will also increase. Now, uh, the surplus monsoon is very beneficial to the Indian agriculture because the Indian agriculture is primarily monsoon dependent. Now, with a sufficient supply of water, the prices of food crops is likely to go down. So the price of food as such will go down. This, however, is if you would like to eat at home. If you are going to eat outside, however, the prices are likely to go up because of GST. We will now look at our investment strategy. With a strong monsoon rollout of GST, consumption growth is going to increase. Labor reforms are on their way, and the low inflation uh, will suggest that the RBI will look to lower the interest rates. And with lowering of the interest rates, we can expect more uh, investments in the coming years. All of these will help boost the equity markets in the long term. However, there are still political tensions that are taking place in our borders to our northeast and to the west. Uh, as some of you may remember, when India conducted surgical strikes into Pakistan, the equity markets had crashed. So tensions with the tensions in northeastern side and the western borders do suggest that there will be volatility in the near term equity markets. In order to avail the benefits of the GST and the consumption, it is best to hold equities for the longer duration rather than to trade it. With the inflation being below the 2% mark, the RBI will likely to lower interest rates. With lowering of interest rates, longer duration bonds will become more attractive. So it is good to have longer duration bonds in your portfolio. The world economy is expanding only moderately, as the G20 had suggested. And there will always be geopolitical tensions because of the slow growth. All of these will fuel volatility in the global markets. And during times of volatility, gold becomes a very attractive investment. Now, with the United States not expanding at as much a faster rate as expected, gold will become gold will rally. However, gold cannot be used as an investment. It can only be used as a hedge against the portfolio against the volatility. With all of this, we now reach the end of our webinar. Thank you so much for your participation. We are now open to questions. We have a question regarding what is India's debt to GDP ratio. India's to GDP ratio is hovers between about 60 to 70%. It is still much more sustainable than most of the other developed economies. Any more questions? Do we have any more questions? We have a question. We've seen the Indian economy grow 8 times in the last 4 years. Will it grow the same way? Um, I'm not particularly sure the Indian economy has grown 8 times in the past 4 years as such. On average, the Indian economy has averaged at about 7% growth in the GDP for the past 4 years, which suggests it has grown by about 30%. So the Indian economy is about 1.4 times what it was about 4 years ago. The Indian economy, however, has grown much faster since the 1990s. With regards to the sustenance of the GDP growth, consumption in the Indian economy is the biggest driver of the growth. Now, with the rollout of the GST, consumption is likely to pick up. Additionally, because of the monsoon, inflation is likely to go down, which means that there will be greater demand. This will suggest that the consumption activity will pick up. Now, with the Indian government initiating reforms for attracting investment in India, we can see the expansion of the Indian economy to reach about 7.8% to 8.5% in the coming years. So, in the coming years, what depends entirely is on how much of the reforms are executed to the dot. Do we have any more questions? We have a question regarding the equity markets. With the Sensex and the Nifty scaling new highs, where do we see this heading? So the equity markets are primarily driven by macroeconomics more than anything else. The macroeconomic situation of India suggests there will be an expansion, especially because of the GST being rolled out. India being a bright spot in the world's otherwise dull economy will suggest there will always be more investment coming towards India. Alongside this, we will see investments picking up because of the risks undertaken by the government. All of this will suggest that the Nifty and the Sensex will continue to scale new highs. But that will not be in the immediate term. In the longer duration, we will actually see the Nifty and the Sensex reaching all new highs. In the immediate term, we still have a few volatilities that are occurring, especially considering the border situation. We have another question regarding the equities. Is the equity market a bubble which will blow up in some time? Recent indicators suggest that the equity markets is a bit overheated, yes, but we do not see it as a bubble per se. There will be a bit of a correction, but it will not blow up. We expect that the equity markets will rally in the longer duration. We have a question regarding what could be the impact on the long term and short term due to the GST. The short term impact will be that there will be an increase in the consumption activity, because the GST has been largely positive for daily consumption activities. Now, the longer impact is that because the GST is more of a unifying tax code, there'll be seamless movement of, I wouldn't say seamless, but the movement of goods between borders will become much more smoother than what it is right now. Now, with movement becoming much more free, what we can expect is investments to pick up in the sectors of manufacturing. So in the longer duration, what we can expect is with the unifying tax code, investments in manufacturing will pick up. Consequently, it will boost investments in India. We have a question regarding how has Make in India helped the Indian GDP grow till now and in the future. The Make in India initiative is mostly they're mostly investments to attract. It's an initiative to attract investments specifically in manufacturing. We have seen a few big names coming to India to set up manufacturing services. One of them including being Apple. Now, the Make in India scheme has also attracted investments in our defense sector. The defense primarily was primarily meant only to be held by Indian companies. The Make in India initiative for defense will free up a lot more of the Indian resources, thereby improving both the defense spending as well as the economic activity in terms of manufacturing in India. So financially, India will be better off in terms of reducing imports of weaponry and military related equipment. But at the same time, we will also see that the manufacturing activity will pick up, thereby adding jobs to the Indian market. We have another question regarding Make in India initiative. Will the initiative of Make in India be a challenge to China? Ideally, no, because the Chinese manufacturing activity has boomed in the last few decades. That the technological advancement in the Chinese manufacturing is much higher than what it is in India. Consequently, the lower manufacturing activities will move towards India, whereas the advanced manufacturing will still be with China, considering their technical and their labor advantages. Now, we have a question regarding how to approach equity in this bull market. In the bull market or in the bear market, we do not particularly look at timing the market as such, because what we see is where the equity will be heading in the longer duration. Our fund philosophy is to invest for the longer duration. We do not believe in trading. So any time is a good time to invest. So even though there may be volatility in the coming, in the short term or the near term, in the longer duration, we will still see the equity market getting to new highs. Now, due to an increase in tax on services industry, will there be an impact on IT services? Uh, the impact on IT services will only be in the immediate term. Over the longer duration, IT is a necessity. So we do not see IT uh, IT will continue to have a strong demand despite the GST. So IT services in the immediate term may have a bit of an impact, but in the longer duration, we do not see anything happen. We do not see anything to affect its growth as such. Uh, we have one more question. So, do you suggest new SIPs can be started in this market, or let the ones which are active to be continued wait for correction to start new SIPs? Um, SIPs are essentially designed so that your investments can tide over the volatility. The advantage of an SIP over a one-time purchase is that despite uh, despite the volatility, your portfolio is more stable when you invest in an SIP rather than in a one-time purchase. So we would recommend that you start an SIP immediately, because delaying an SIP will also mean the longer duration you will stand to lose as much as about 2 lakhs in a year. Are there any more questions? Thank you so much for participating in the webinar today. We hope we were able to address some of your queries. We hope this webinar was quite informative to you. I hope you enjoyed it as much as we enjoyed presenting it to you. Feel free to reach out to us at research@arthayantra.com regarding queries about economics and investments. We will be happy to help you out. Thank you.